Hi everyone, thanks for taking the time to listen to this presentation. It's Matt from Sharp Medical Accounting. The purpose of this talk is to bring to the surface some of these really key facts regarding pension taxes that we're all hearing about in the news at the moment. This is not advice, it doesn't constitute advice, but it does serve as an opportunity for me to bring to your attention the points that really matter when it comes to potential tax problems in the future. Of course, this may lead on to further discussions on a one-to-one level, but as I say, the purpose of this exercise is just to establish some key facts so that we're all familiar with at least the basics of what is a complicated scenario and a pretty grim scenario as well. I think it's pretty fair to say that this is a crisis for the NHS at a time that it least needs it. So first of all, we will address some terms that have been commonly used and just define them. So one phrase that we hear is annual pension input allowance. This is the amount of growth that can occur in the NHS pension scheme, or in any pension scheme, but in this case the NHS pension scheme, that is exempt from tax. So at the moment the annual pension input allowance is set at £40,000. That means that every year the pension pot can grow by up to that amount and there will be no tax payable on it, so it goes unpenalised. And that's a satisfactory situation for those who have got pension growth less than 40k. So that's pension input allowance. We then talk about tapering and what that entails. Tapering is the term we're using in this context to describe the reduction of the £40,000 in line with a doctor's income. So in my previous definition, I said to you that the annual pension input allowance was 40k. Recent government legislation has meant that if total income is above a certain level, in this case 150,000, that £40,000 input allowance is tapered downwards. And of course, if that input allowance is tapered downwards, we're potentially exposing more income or more pension growth to tax. And that's where it's particularly harsh, in my opinion. So tapering is the reduction in the £40,000, and it should be noted that in any given input period, or in any given tax year, should I say, the pension input allowance can fall no further than below than £10,000. So once you've hit the £10,000 input allowance, that is it. You can't go any lower than that, no matter how high your income gets in the year. So that's the annual allowance covered and tapering. The other two phrases that I hear, it almost seems daily at the moment, is threshold income and adjusted income. With regards to definitions here, threshold income is your gross pay. So for a typical hospital doctor, that would be the NHS salary, less professional subscriptions, plus perhaps private practice profits or dividends or rental income, less employee pension contributions. So that's key. The employee pension contributions come off at this stage. And the result there is threshold income, or in accountancy language, we might refer to it as gross taxable income. And in the example here of a hospital doctor, you'll see that this consultant has £120,000 worth of gross NHS pay. He has got £17,000 worth of employee pension contributions coming off that, £1,200 worth of professional subs coming away, and a little bit of other income. And we arrive at threshold income. Threshold income is calculated in order to determine whether or not tapering is to be considered. And it very much is a cliff edge scenario here. If threshold income in any given tax year is below £110,000, tapering, which we're calling a bad thing, is not considered. If it's £1 above 110,000, it is. You can imagine there's a scenario here where a doctor goes into his hospital, into his trust to help out on a Saturday morning, just help out his team, thinks he's doing the right thing, and just for the sake of that one extra shift, brings a a multitude of taxes into the equation, unknowingly. So that's the significance of threshold income. We then move on to adjusted income. So adjusted income is the threshold income plus the deemed growth in the pension pot. And in this doctor's case, we can see £103,000 worth of threshold plus £55,000 worth of deemed pension growth. We add them two together and we arrive at adjusted income of 158,400. If adjusted income in any given tax year is above £150,000, the bit that's above 150, so in this gentleman's case, £8,400, we divide the number by 2 and we deduct it from the £40,000 input allowance. So we're basically saying, because this gentleman has got high income, the pension input allowance is being dropped. He's been penalised for having high income. In the column that we're looking at here, though, we've already said that his threshold income is below 110, so he is not required to consider pension tapering. But that's a good stroke of luck, because if that was anything above 110, we can see here that tapering would have been an issue because adjusted income was above 150. So if we work through this example, and then we'll look at what would happen if this guy took on another 10 grand's worth of work and how much money he would get to take home to his family. And the results are shocking. So working from top to bottom here, we've agreed that the gent has got £103,000 worth of taxable income. We've agreed that he's exempt from tapering in this year. It's not an issue. We do know, though, that his pension growth was 55k. So that's come from NHS pensions in the autumn. It's per the statement, and we place reliance on that being correct. The adjusted income in this example, not to be considered, because tapering is irrelevant. So quite simply, we do 55k growth minus the £40,000 input allowance that everybody has before tapering. And the difference, being the 15,000, is taxed at this gentleman's normal rate of tax. So okay, it's a tough deal. He is paying tax on £15,000 worth of excess contributions. However, the crumb of comfort is he did maintain the full 40k input allowance. If we scroll down a touch, you'll see here that there are no extra earnings. So in this example, it's quite simply, this is his starting point. There is no extra income. But then we say, what if this same person takes on £10,000 worth of extra work, possibly through private practice, or maybe as in this example, because he does more work for the NHS. And for the purposes of this exercise, I'm considering the extra income not to be pensionable. So yes, it's taxable, but it is not pensionable. So in this case, £10,000 worth of extra salary and everything else remains unchanged. Sure enough, you'll see that we've gone above the 110. So tapering, yes, immediately the alarm bells start to ring. For the sake of that extra 10 grand, we've got taxes to consider that we would not have had to consider had he not taken on the extra work. Sure enough, the pension growth remains the same. We said that this was not pensionable, the extra work, so we expect that number to remain the same. The adjusted income, though, has gone up by the 10k, as you would expect. We then say to ourselves, okay, we've got tapering to consider, and sure enough, we are above 150 in terms of adjusted income. So, having done the workings, we have to deduct £9,200 from our input allowance, because we're £18,400 above the 150. This leaves our client with a pension input allowance of 30,800. Was 40, but it's now 30,800. We then take the 55k growth, or deemed inputs, shall we say. We deduct the annual allowance, which is his tapered annual allowance of 30,800, and the difference is taxed at his marginal rate of tax. So, of course, we can immediately see an additional tax here, simply as a result of taking on the extra work. But of course, after all this complication, what does our client get to take home as extra cash? So we look down at net pay and we say, okay, compared to scenario 1 where he did not have tapering, he took on another £10,000 worth of work. There's no extra employee pension contributions because it's not pensionable. So we haven't lost anything there. We have lost 40% tax, however. We've also lost some of our personal tax allowance. That's nothing to do with pensions, by the way. That is just what happens when you go above £100,000 worth of income. You start to lose your personal tax allowance. There's a tiny bit of NIC, but the real damage comes with the pension tax. So as a result of taking on the extra 10k, we can see that the pension tax has increased by £3,680, which we have to attribute to the 10 grand. We have to bring that into this computation. So the guy's done the work, he's made the 10 grand. He's lost £5,340 worth of what we call normal tax. He's lost a bit of NIC along the way, and then this pension tax comes into play. We rework the numbers, and out of 10,000, our client takes home just £780 to spend. So 8p in the pound, an underlying rate of tax of 92%. Now, of course, that's highly unattractive, and the vast majority of people I know who work in the NHS wouldn't do the work for that type of reward. But of course, this is a silent tax. People can blindly walk into this. And I hope that that example provides food for thought when it comes to taking on additional work. Indeed, it may even exemplify how reducing work can be a good thing. So, for example, if you were at £113,000 up here of threshold income, there is no doubt there is an incentive to drop your income to get below the 110. The 109,000 is ideal in this guy's case. But of course, we're hearing that the NHS is under more and more pressure. Hospital doctors are refusing the work. The demand for the service is higher than ever before. And therefore, whilst you've got pension taxes on one hand, you've most probably got the bosses in the hospital pleading that you do the extra work, and that leaves a moral dilemma. It would be well worth looking across at these computations. I'm happy to provide them in a PDF if you would like. It shows what happens as the salary increases by 10k, 20k, 30k, 40k. So if we keep looking down at the bottom here, sure enough, the net tax, although the underlying rate of tax is severe. This 72% tax looks relatively acceptable. But I think in a normal tax year, most people would say, I won't bother doing the work for a 72% tax rate. And of course, these numbers do not factor in lifetime allowance tax, which could also be compounded by doing the extra work. It's on the face of it, it's a bleak scenario. And if you're faced with the perfect storm, like this gentleman is here, it could be really disheartening to those who want to get on and want to earn more. I'd be interested to hear what your thoughts are on this. I'd be more than happy to comment a little bit further and talk about your specific circumstances. There's no doubt that this is a crisis, and we'll have to wait and see what the government do to rectify the situation. Clearly, it would be advantageous, it would be to our benefit to see the scrapping of the taper. I think it would be a fair consolation if we knew that everybody in Britain had £40,000 worth of pension input allowance every year. But I think, to my eye, this seems a long way off. There would have to almost be a specific rule for those that are in a final salary scheme, in a defined benefit scheme, to get by this. We've also heard of this 50-50 arrangement, but again, I've heard that there are drawbacks to that. Most notably, in some situations, the 50-50 way of resolving it, where you put 50% of your, or basically you reduce your contributions by 50%. That can bring people into tapering that were not in tapering in the first place. So that could backfire. We're also seeing hospital doctors form limited companies to collect their private practice income, or even own properties in companies. There's no doubt, though, that there is an incentive to take income off your tax returns, if you possibly can, and put them either into other family members' names or into companies, just to keep your income at low levels, ideally below 110. So I hope to hear from some of you soon. I'm sorry that this is such downbeat news, but I think it has to be said. And I will keep you posted on how things develop, if they develop over the next few weeks and months. I'll try to put together another one of these videos over the next week or two, looking at ways of potentially minimising the damage. But I think it's fair to say at this stage that this is a tough set of circumstances, and it really is a case of damage limitation for most. Thanks for listening to me. I hope the message has been well received, and I look forward to speaking to you soon. Thanks for now. Bye-bye.